Hello, and welcome to today's webinar, New Retirement Realities, Annuities 101. Today, we will hear from Security Benefits Mike Reedy, Vice President and National Sales Manager of the RIA channel, Avantis Investors Chief Investment Officer, Eduardo Repetto, DPL Financial Partners Founder and CEO, David Lau, and Tony Sirianni, Publisher and CEO of Advisor Hub. In this webinar, we will uncover the potential of annuities in shaping a stable retirement for clients, including core concepts of annuities, including types and benefits, how annuities deliver accumulation potential and income, strategies for leveraging annuities to grow your practice, how to effectively manage market risks through annuities, and potential tax advantages associated with annuities. The Investments and Wealth Institute has accepted this webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. It has also been approved for 1 CFP CE credit. During today's presentation, should you have a question, please click the Q&A icon at the bottom of your screen, and we'll do our best to answer it. Now, to kick us off, here is Tony Sirianni.
Thanks, Pat. That was very helpful. I appreciate that. And welcome, everyone. Thanks for joining us today. This is pretty exciting. I'm very interested to hear what this high-end expert panel has to say about annuities. It's an interesting product. And I think in today's environment, and we're going to talk a little bit about what's going on today and how advisors are impacted by some of the new things happening to us today. I think we're going to learn a lot. So I want to kick it off quickly to Mike Reedy, and then we'll get back to discussing it.
Thanks, Tony. And first, great to be with you and Advisor Hub, and Security Benefit is proud to sponsor today's webinar CE, and we're very appreciative. Two of our industry thought leaders, David Lau and Eduardo Repetto, are participating as well. Pat, why don't we put up our poll? Thought we'd kick it off with a poll, and our first question is, have you recommended any type of annuity over the last 2 years? Yes or no? Any type of annuity over the last 2 years? And let's go to the, okay, so almost 2/3 have recommended annuity over the last 2 years. Very good. It's good for us to know our audience. And why don't we go to the second poll? And this is just a continuation of the first question. You can put up the second poll, Pat. So those of you that have recommended annuities, those 62%, was the principal reason for an income benefit, yes or no? And if you want to put, I have not recommended annuities, you can do that too. Okay, almost half.
Yeah.
Very good. And 20% and 32% have not. Okay, very good. All right, Tony, why don't we turn it back over to you?
Yeah, well, let's go to the next page, the next slide, Kaya, and talk a little bit about, look, in the last 10 years, we've had more change in this business than we've had probably in the last 70 years, right? I mean, it's been an incredible amount of turnover. And from a markets perspective, there are a lot of advisors on this call, I would imagine, that don't remember inflation, right? This is the only time it's happened for them. A lot of advisors haven't even seen rates really rise, right? I mean, so this is kind of new. So, I mean, how do you think sort of those sort of unique things are affecting the environment for advisors today, Mike?
Yeah, I mean, you can see here reliable sources, income sources have been disappearing. I mean, granted, rates have been moving up over the last 2 years or so, but we were in a zero interest rate environment. Yeah. So the traditional people that were just buying CDs and just going off what was guaranteed really was not available. Even today, when you look at what the dividend yield is in the S&P 500. It's very low compared to cash. Pensions is a big deal, very big deal. I mean, just to give you an idea, 35% of companies offered pension plans back in the early 90s. Today it's only 15%. And if you plan on getting a pension, I guess you're going to be working for the government, because about 86% of government employees get a pension, but virtually nobody else does. We're going to talk a lot about, I think, interest rate risk that we've seen over the last year and a half, as I mentioned. And the other thing too, Tony, is longevity risk. Is really a big deal, and how that just the
well, you
just
worry about
folks living
that a
longer.
lot. You worry about that a lot as interest rates are rising. Am I going to outlive my money? Right? That's a serious problem. And advisors have got to have a good way to talk about that, because I think today, now it's more of a holistic planning culture. You got to look at both sides of the ledger. So how am I going to, you want to address those fears and concerns, right?
Oh, absolutely. And when we just think about life expectancy, and how do we plan for that and manage for that. We know that statistically it's an 84% chance that a 65-year-old couple, one of them is going to be alive at 85.
Yeah.
And it's a 50% chance somebody's going to be alive at 90.
Wow.
So we're talking about long retirements. Insurance, annuity insurance companies can be a solution, part of the solution, as far as this whole longevity conversation. And just to you think about, even historically, I remember going back, this is maybe 10 years ago or so, I was in a firm out in Pennsylvania, and I asked the advisor, I said, what do you do for a client that's looking for income? And their solution was like, we just we'll take some withdrawals from the brokerage account. And I think those days are over. I hope, at least. And that just goes into the last point here, as far as the 60/40 portfolio.
And that's where you're hearing a lot about the 60/40 portfolio being under pressure, right? There's been articles all through the journal. It's no longer the way to go. And the 4% withdrawal, I mean, still, I hear people every day talking about that's the number, 4%. You got to be able to do that. But the 60/40 split has really taken a beating lately.
Yeah, and yeah, exactly. And maybe we'll do another CE on a 60/20/20 allocation. We're big believers in how do you allocate a portion of your fixed income portfolio to annuities. And that's something maybe Eduardo can talk about a little bit later. But also, when you think about 60/40, where's the alternative component? But even with the withdrawal rate, we've been reading over the last couple of months. Morningstar just came out with recently with a research paper. They're recommending 3.3%. Because of inflation and market volatility. Even Bill Benjen, who we all know was a financial advisor that really coined the 4% rule. He agrees with what Morningstar is saying. It should be less. So, this whole 4% no longer holds up. And I think, to your point, Tony, the whole idea of how that allocation is going to be. I think we're all taking a look at it, but that balance 60/40 doesn't seem to be a good fit for many people going forward.
Well, you have to balance the risk, right? You have to talk about risk with people. And then the other thing is that immediately comes to mind, and I know we have people to talk about on the call, but there's opportunity too. So when we have this, so what do? We realize we're in a rising interest rate environment. What do you put your clients in? We realize that the pensions are being eliminated and all that kind of thing. And I'm not sure that this interest rate risk is going away. Maybe that's more of an Eduardo question, but at the end of the day, what's the opportunity?
Yeah, I think the opportunity is that from a an insurance carrier perspective, we're certainly, we've participated very nicely in the rise of, as interest rates have risen, our fixed rates have done very well. We're bringing, the flows have been very good from an industry perspective. So, it's been good for us. But that's not to say, when rates were lower, we were, all things being equal, we were doing very well. So, where is that fit? But I think the challenge is that, making sure that clients have a dependable income source, and they got that peace of mind that they're not going to run out of money, if you will, before they run it out of life. And in many cases, clients are looking for, at least a portion of their assets that the principal is guaranteed and that the income is secure. So, that's where, the annuity products to a large degree, really fit that client objective.
So we have another slide too to talk about some of the changes in the landscape, addressing some of the stuff we're talking about now. So, Mike, your point of view on some of these things. I mean, this is sort of giving us some of the answers to the challenges.
Yeah, and just to, when you think about some of the different types of annuities, we were talking about this before we went live. I think it's kind of like an old story that, annuities are complicated and expensive, because that is really not the case, at least in the advisory space where David Lau and myself sit. The insurance carriers have really stepped up to make the annuity contracts much more simpler, much less expensive, very easy to understand. There's no hidden costs, things like that.
And I think that's important. We were talking about that. We just said in the beginning how much the industry has changed in the last 10 years, but so have these products. I mean, for me, who, I last sold them sitting at a wirehouse, it was a very different, product. And today it just seems like there's a lot more opportunity in them.
Well, just to give you an idea, I mean, obviously, if in the advisory space, they're commission free. All the annuity products are commission free. You can't have a commission on an annuity if you're obviously a registered investment advisor. So that's a given. But what's happened, and I really credit kudos to David and DPL, because they've really pushed the carriers, the industry carriers, to say, why do you have, for example, a contingent deferred sales charge in your annuity product when it's an advisory product? Well, from a I guess an actuarial standpoint, we wanted that protection. But right now at DPL, you can actually purchase, whether it's fixed, variable, fixed index annuity, not only commission free, but without a contingent deferred sales charge. So these type of annuities that I'm mentioning, that people think are complicated, expensive, hard to understand, hard to explain, that's all really old news. I mean, we've really, in the last, I would say, year and a half, 2 years, have really stepped up as far as what we're doing.
And it's not really that comfortable to talk to a client about a contingent deferred sales charge. That's right. It's always just a crappy conversation. So to be able to say, hey, we've developed this program, I mean, that's pretty cool, I think. Oh yeah,
and I mean, just to the third point there, and we're going to get into it a little bit more later, but the regulation and technology, and specifically on the technology side, annuities are much, I think, easier for the advisor to have in their their business offering, and to actually manage it on their wealth management platforms. And we'll get into that a little bit more. But that was really a challenge, I think, for us from an industry perspective, that annuities were pretty much, let's call it like off balance sheet. It was not part of the consolidated statement. The advisor had a really hard time, if you're charging a fee, or, where is this asset? The client can't find it. Those days are over too. So we've made it a lot easier for the annuities to be incorporated into the overall plan.
Yeah. You can't emphasize that enough, because that's a big deal.
Yep.
Especially if you have your own RIA.
So it's, just to wrap it up here, Tony, we think that, as far as, our growth, especially in this space over the last 3 or 4 years, has been exponential. When we go back, we started, for example, Security Benefit over 10 years ago in the advisory space. Part of our issue back then was we were one of the few companies in the space, and it was very difficult. Today, that's not no longer the case, as you see from the poll questions, that advisors do see the benefits. But you can also see from the poll questions, we have over a third that have not recommended an annuity. So we know that there's, obviously opportunity to educate and for growth. So we appreciate, those folks being on the call too this afternoon to learn on what we're doing.
Great. I think we're ready for the next slide and for David. So David, you're gonna have to go through this with me because for some of the stuff I don't know, some I do. But just to sort of dovetail on what Mike was saying, it is a really great time to be doing these products, given the fact the no commission and the CDSC stuff. I mean, that makes a big difference for an advisor sitting down trying to figure out where this fits in their book, right? Because this really gives them the option to sort of look at both sides of the ledger with their clients.
Yeah, annuities have always, because of their compensation structure, have always represented a conflict of interest. So whether you're accepting the commission and you're taking your favorite commission product, that was one kind of conflict. Another kind was you're a fee only or fee-based advisor and you can't accept a commission, so you're not going to recommend one, because as it was known in the industry, that would be a nuicide. You're killing your practice by, sending assets outside of your management to the insurance carrier. So what commission-free annuities enable is the relief of that conflict of interest. So now there is no conflict in incentive for a financial advisor. They can recommend an annuity, they can bill on an annuity in the same way they can any other asset.
Yeah, fantastic flexibility today in that.
Yeah, exactly. And building on what you and Mike were talking about earlier, Tony, this is a much different landscape today than it was even 5 years ago. 5 years ago, prior to founding DPL, I built a carrier called Jefferson National, and along with Security Benefit and TIAA, and we're pretty much the only games in town, relative to annuities that, were no load, and they were really focused on investment only variable annuities. So you couldn't get all the kinds of, variety of products and all the kinds of, riders and protections that annuities can traditionally bring. Today, that's not true. There's every type of annuity, available to, fee only advisors, that can be billable assets within a portfolio, not just investment only variable annuities anymore. And that's a real, innovation and, a real change in the financial services industry over the last 5 years. And I would tell you, when you see the impact, and I think Mike was alluding to it, when you take the commission and the distribution wholesaling expenses out of a product, you're dropping the price between 50 and 80%. And I would tell you that's the most impactful change. Commission-free annuities are the most impactful product launched in financial services since the ETF. Now, this is game-changing for the end client, and it's game-changing for the financial advisor, who now can bring in, risk management, into, pure risk management into their practice in the form of annuities.
Well, like the ETF, which has lowered its costs, and now people can use them in these kind of programs, right? It's the kind of thing advisors need to look at. And in your mind, the FIA, the fixed income annuities, I mean, we should talk about how these different products fit in. I think people want to hear about that.
Yeah, so let me just go through the roster really quickly, because one of the things that always got my goat in reading an article about annuities, you'd hear the academics giving all the pros about the annuities. Academics love annuities, by the way. And then you have some random, RIA advisor saying, well, I don't like them because they're complex and expensive. And well, there are many different kinds of annuities. And with commission free, expensive's gone, across the board, but it was never true, right? MYGA, this is a very simple product, has always been a simple product. There isn't just one annuity, right? There's all different types. So a MYGA is most analogous to a CD. It's, you're making fun of the CDSC earlier. MYGA is multi-year guaranteed annuity, right? So the industry loves these acronyms, but it's analogous to a CD. It's just a fixed rate product, with a multi-year duration. And you're typically looking at products that are just used in accumulation. You can use them, all annuities you can annuitize, turn into a lifetime income stream, but nobody does that. They do it through riders. We'll talk about that. But MYGAs are typically just used in accumulation, though some these days have income riders. That's another relatively new advancement. Fixed indexed and registered index linked annuities, or RILAs, FIAs and RILAs, these are becoming the two big product categories within the annuity landscape that everybody should be aware of, because they're both relatively new in their form. And the difference is they accumulate rather than like traditional variable annuities or where you're investing in funds. You're investing in indices rather than individual funds. And the reason these both have become popular is because that simplifies the investment selection. It simplifies the investment choices. And for the carrier, it simplifies the hedging and the underwriting and gives them the ability to provide much more attractive income riders. So you're typically going to find much better payout rates in FIAs and RILAs than you are in variable annuities, which frankly rival the traditional income annuities, the single premium immediate and the deferred income annuities. So becoming familiar with FIAs and RILAs, I think, is really important for advisors, both because they're relatively new in their current form, and because these are becoming the preferred products of choice, both for advisors and for clients and for carriers.
Well, someone's asking, David, what's the difference between a fixed, not indexed annuity versus a deferred income annuity?
So a deferred income annuity is purely like longevity protection, right? You're buying, an income stream to kick in at some later portion, later date for a client. So there's, and when we say there's a fixed accumulation rate, it's kind of an implicit one built into the product. There's no like investment aspect for an advisor or client. Really, the carrier is looking at that asset and projecting growth for whatever 15 years. If you're buying it for a 65-year-old, and you're going to have income kick in at 80. So it's really, that's the traditional DIA. The fixed indexed product, you're going to invest and you're going to control where the assets get invested, whether it's in a fixed account or an index, and you're going to have some control over the accumulation and then flexibility as to when you're going to turn income on.
Great. Well, thanks for that. So David, just let's go through the next slide. I don't want to be missing anything, but we want to get to everything too.
Sure. So while the annuity landscape has really grown and changed over the last number of years, we see there's two primary uses for annuities. One is accumulation, prior to retirement, prior to beginning to take income. Annuities have some unique benefits. One is you get tax deferral. I mean, you get virtually unlimited tax deferral in an annuity. You can invest millions of dollars into an annuity and get tax deferred growth. So this is really appealing for clients who might be high income earners, just pure tax deferral. High income earners who want to defer a lot of that ordinary income. Maybe you want to use an annuity for asset location, to put tax inefficient assets within a low cost annuity wrapper effectively. So tax deferral is really important, as we know, for accumulation. And the other way advisors are using products is for downside protection during accumulation. We'll talk a little bit about that in a couple of slides, but bringing in true guaranteed risk mitigation rather than strictly leveraging portfolio diversification for protecting client assets.
Yeah, I think what's interesting about this too, David, is that stressing the sophisticated use of these products, versus, hey, this is just a pension replacement. This is really an opportunity to talk to some of because a lot of advisors that, have high net worth books, right? And ultra high net worth people in there. So.
Correct. And these can be for, many clients, even, particularly when you look at income for higher net worth clients, because, one of the things I think the annuity, industry has always done, and, we talked about this in prep, Tony, you always talk about greed and fear, right? Annuities have always been positioned against fear. Let's not, let's use this to make sure you're not outliving, your assets. It's been focused on the longevity protection. But really, to me, one of the primary benefits is the greed aspect, where annuities fund income a lot more efficiently than fixed income does. So you can get more income for your dollar, basically, out of an annuity than you are going to get out of traditional fixed income investing, which is really a great use for an annuity with income. But the protection aspect, now you can also leverage, FIAs and RILAs, for, clients as they accumulate, using the downside protection, particularly as you're nearing retirement, where, clients start entering into that sequence of return danger zone, that they call the 5 years, before and after retirement, a great time to start leveraging that downside protection.
Great. Well, let's another slide, right? Let's keep growing.
Yes. So accumulation strategies, I touched on it a bit in the last slide. Maybe I jumped ahead of my content, but
Right.
using asset location, and using an annuity. This is one of the things we did at Jefferson National is, leverage low cost tax deferral, for assets that are, tax ugly, things like ordinary income, things that have high turnover rates, stuff like that, put them inside a tax deferred wrapper, and you're going to get the benefit of tax deferral and helping them grow faster. And the trouble has historically been that is a terrific strategy, but hard to execute. Because you would have assets held away in annuity, you couldn't see them, any longer, and then you have the rest of the portfolio. So you have your tax efficient assets within your brokerage account, and your tax ugly assets in your annuity, and it was hard to actually implement that. But today, as you guys were talking about in the intro, more and more you've got annuity functionality and annuity positions integrated into the portfolio management systems, particularly in Black Diamond, Orion, and other systems, where you can see those assets together and much easier to execute on an asset location strategy. The other is de-risking with during using annuities during accumulation, where you can look at fixed income diversification sources, and I think Eduardo will talk a little bit about this, but using an FIA as a differentiated source of fixed income returns with a downside protection, because an FIA, a fixed indexed annuity, has what's known as a zero floor. Your clients can't lose assets in the product due to the performance of the market. So you've got a zero floor. It's a great downside protection, relative to fixed income, as you get near and into retirement. And the other is the RILA, right? So the registered index linked annuity is going to similarly invest in indices, but you don't have a zero floor. Most commonly, you've got a 10% buffer, they call it, which means 10% downside protection, meaning you invest in a RILA, say you invest in an S&P index, and the index is down 12%. Well, your client or you only lose 2%, because the 10% is absorbed through the product structure. If the index is down 8%, your client would lose nothing, right? So you get that level of protection, and the benefit to having that buffer rather than the complete downside is you get higher accumulation potential. So in an FIA today, we look at FIAs as more fixed income replacements. You're seeing cap rates in the indices that you can invest in the neighborhood of 12.5, 13% for an S&P. When you look at a RILA, an S&P index, you're going to see like 25% cap, meaning that's the cap you can earn in a single year within that strategy. And so you see FIAs used as fixed income replacements, RILAs used as equity replacements for those clients who can't afford risk but still need some upside.
And I also think it's not just clients who can't afford risk. What I'm sort of picking up here is if you are a high net worth client, there are opportunities too. I mean, you sell a business, you really don't want, this is your principal you don't want to lose, right? This is the stuff you really want to protect. So it's a know your client type conversation.
Yes, or even younger clients who just don't have a risk appetite, right? So it's a way of bringing in some downside protection while still giving them some market-like upside. And and just to be clear, I'm talking about RILAs when I talk about market-like upside. FIAs, we're talking about fixed income replacement.
Right. Well, let's try the next slide.
So as we work with advisors and DPL, we work with thousands of RIAs across the industry. It's one thing as we educate them on product and they think about, okay, how do I use this product? What are the purposes? For whom do I use them? When do I use them? Then the next question is, well, how do I fund it? Like what do I do execution wise? How do I fund these products? Where do the assets come from? So generally what we're seeing is a lot of shifting from bonds and fixed income into fixed product. MYGAs, the CD-like, fixed products, have been extremely popular with RIAs over the last couple of years as interest rates have risen. Just to give you a sense, on a 3-year MYGA these days, they're paying out about 6%, which, is a terrific rate, and it's tax deferred. And using FIAs as well for a diversification of risk within the fixed income portfolio. And particularly as we get towards retirement and you're going to use a product for an income stream, and FIA has been an extremely popular strategy to protect downside risk and then turn into income. The other is like one of the most obvious ever is repositioning existing annuity assets, whether you sold the annuity to your client or in likelihood, if you're an RIA, somebody else sold your client an annuity. About 25-30% of your clients, know it or not, probably own an annuity. Taking that annuity and repositioning it within your financial plan. So one of the reasons I wanted to start DPL out of Jefferson National was because the only solution we had to repositioning annuity assets was to lower cost and put you into an investment-only variable annuity. And that might not be the best thing for the client for a number of reasons, or your practice, by the way, for a number of reasons. One is the client might have bought that annuity because they liked the idea of the income guarantee, right? So now we've got commission-free annuities that can replace that and give a guaranteed income stream in a commission-free fashion. And two, importantly to your practice, when you turn that annuity, you use it for income, particularly that held away annuity, you don't have to hit the rest of the portfolio nearly as much to generate income in retirement. Use that annuity asset, which is going to really efficiently generate income, to fund income needs in retirement, leaving the rest of the portfolio more intact, and having to hit it less. And then using equities and stock investments, like I said, for was talking about for RILAs, where you've got clients with lower risk tolerance for whatever reason. They just do. They've got a business they've sold. They want to protect assets. They're approaching retirement. Taking some portion of the equity portfolio and putting that downside protection on it while still giving them some accumulation capability has also been a really popular strategy.
Yeah, I mean, we talked about the 60-40 maybe going away. We talked about 40-40-20, before. And this looks like a situation where you've got to think it out, and if you think it through, I think some of the rationale that you went through makes a lot of sense. If I'm positioning my clients in terms of, hey, I can do this with their equity portfolio if I don't have to worry about income.
Exactly. So it gives you, it just gives, commission-free annuities just give fee-based advisors a whole new set of tools, right? So it's a whole new set of tools to manage assets, to attract assets, to meet your customers where they are, rather than everything being an investment solution. Now we can bring insurance solutions into the mix. And as we've seen, what our basic promise to advisory firms is, we're going to help grow your practice. That's going to be the biggest thing. We're going to preserve assets through income. We're going to help attract assets as you grow.
And also let's take a look at some of the assets, the annuity assets your clients may already have that you don't know about, you've not looked at it. It's part of your job. You should be looking at everything. So and now maybe you have an opportunity to sort of give them a better option.
Exactly. And we've, not to make it a DPL commercial, but we do bring in, we've got technology that we bring into all this. We can do instant annuity comparison, calculations. We've got a one-of-a-kind tool that within seconds you can look up your client's existing annuity, and we can give you an instant comparison to a commission-free version, which, as you'll see in the next page, when we start lessening the costs, is going to give you a much better, your client a much better outcome. So just to run through this is the typical commission annuity. According to Morningstar, the M&E on a variable annuity, it's the easiest way to see it. Average M&E on a variable annuity is about 143 basis points, earning its reputation as being an expensive product. And that's because the insurance carrier's got to recoup the commission. They've got to recoup the internal distribution charges. And where we're going to get into the math on the commission-free products in the next page, but where you're seeing the role of commission-free annuities, I've been touching on a lot. One is they're fiduciary friendly. They align with your business model. They're billable assets. Two, they can complement a portfolio strategy. Again, it's not the reputation of annuities do everything. These are complementary tools for particular purposes within accumulation or decumulation, retirement income. And importantly, when commissions are removed, these products are repriced, giving the insurance carrier effectively additional budget to put into the product rather than having to pay out for distribution.
Yeah, common sense, right? This is we got to figure out how to put this in our portfolios, and this is, I think, the thing that people were afraid of, right? This is, if I'm an advisor RIA, this is why you avoided them, because your fiduciary obligation, your client, you're thinking that it's just going to cost them too much money. It's just over time, I'm going to make this up in some other product.
Correct. And that's why, eliminating, we're going from A shares to I shares, when mutual funds, have been making that move forever, right? Nobody sells A shares anymore. Mutual funds have all gone to I shares, right? This is basically the same thing. This is what's happening in the annuity world. It's moving from A shares to I shares, and the change in pricing is dramatic.
Let's look at the next slide. Show it. There we go.
So there you go. You wipe out the distribution costs. You add in some administrative expense, which gets amortized over the course of the product, and you take that variable annuity, which in the commission world on average, was 143 basis points, and on the DPL platform, we're looking at variable annuities. We've got products with generally 0 to 30 basis points of M&A. So that's where you're seeing that that benefit of the repricing. In fixed products, because there's no distinct cost, the cost is kind of underlying, because they're spread products, much like a CD. What you're seeing is, again, the carrier with more budget to put into the product. So you're generally seeing higher interest rates in fixed accounts and higher cap rates in indices.
Yeah, I mean, this is this sort of explains it all, right? Somebody just asked, are the admin total distribution expenses upfront or annual? I think you did answer that.
Yeah, it's just like the commission, they're just a cost baked into the product. So there's not an actual 1% fee charged. It's the assumed fee within the product costing, which gets amortized. So your annual cost is the 20 basis points, because there's an assumption of around a 5-year duration, by carriers of the asset. So they're amortizing that 1% fee over the course of 5 years. And so, I mean, and this is just generalities I'm talking about. It's different product to product, carrier to carrier, but any cost is going to be explicit in the fee.
Got it. Next, we're going to talk to Eduardo too, or you should. Oh, yes, there he is. Eduardo, good to see your face up there.
Very nice to
Very
be
nice.
here.
Yeah, exactly. So I know you want to talk about fixed indexed annuities, and I'm very interested to hear. Let's hear what you have to say about them, because you are the expert.
Well, I wasn't. So I learned quite a lot speaking with David. So I met David like 5 years ago. Annuities tend to have a very bad reputation because of the things that just David mentioned. When you are starting with a whole of 8% and you have to climb it back, 8% is a big number. So David was showing me that, hey, look, we have a commission-free annuity, so the hole is not there. You're not starting just below water. You're starting at the flat line. And so then you start looking at the benefits that annuities can bring to advisors and advisors' clients. One is clear and obvious. Some of the advisors' clients have other annuities in their portfolios. And so this is providing an opportunity to switch from expensive annuities to more attractive annuities. That's obvious at the end of the day. There is no change. The money is already there, and it's a cost saving. But if you're thinking about asset allocation, I always think about asset allocation. If I'm creating a portfolio, I think about two types of assets. One is growth assets. Yeah, what do I mean by that? Assets that we invest, hoping that we become bigger and bigger and bigger. Like equities. Why we buy equities? Because we think that the expected return of equities is much, much higher than other assets. So we want that, we put money there to grow our amount of money, our savings, And so, but not everyone can invest all the money in equity. Few people can invest all their money in equities. Most people also need risk management assets. And what are risk management assets? Well, David was speaking about them. You can think about fixed income. You can speak about CDs. Well, you can also speak about fixed index annuities or annuities in general, not fixed annuities or RILAs or FIAs. And why I do think them as a risk management asset? Because it has the properties of what you want on a fixed income instrument. What you want from a fixed income instrument? You want principal protection and a little bit of upward. You are not going to get a lot of upward because it's a risk management asset. It's not a growth asset like equities. Well, fixed index annuities have that property. Index annuities give you principal protection and some upwards, but the upward is not related to yield. Like in a bond, the upward is related to yield. Here, the upward is related to the performance of some underlying index. That index is a weight is different from yield. It can be linked to equities, can be linked to any other thing. So when you are thinking about an asset allocation and you have your assets to produce growth, you're complementing that to risk management assets, and that can be bonds or can be FIAs. And what's the benefit of having FIAs? Well, it's a way to diversify what's the source of return of your of your risk management assets. The return will be based on yield. In the fixed index annuities, the return will be linked to the performance of an index that is not related to yield. It can be related to the performance of some equity index. What are you giving up? Because whenever you're investing, you are getting some benefit and you're giving up something. When you're thinking about risk fixed index annuities as a risk management asset, you are giving up liquidity. Why? Because you're buying and holding it, let's say, to maturity. You're holding for a long period of time. So when you think about your overall asset allocation, well, you are going to consider how much liquidity that needs. So depending how much liquidity you need, you're going to put that in bonds that are absolutely liquid. You can sell it at any point. But most people don't need 100% liquidity from their risk management assets. So fixed index annuities, for those people that don't need 100% liquidity from their risk management assets, makes sense. In particular, because the tax deferral benefit. Because if we think about bonds or risk management assets in general, they are onerous from the tax point of view. Income. The income is high tax rates, in particular in certain states more than others. And so if you can defer the taxation until the time that you take your money out, you are getting the compounding effect on that money that you're not paying every year to the government. So from my point of view, it's one more tool for advisors to create a good asset allocation. And on top of that, is one more tool for advisors to map from expensive annuities that when they get a new client, some of them bring those expensive annuities from their investments before they become a new client into something that is more attractive from the pricing point of view because it doesn't have those embedded costs that David was speaking about. So we are always for delivering advisors all the tools that they need to create a better outcome from their clients. The advisor is the one that knows the client. The advisor is the one that knows the sensitivity, the liquidity risk, the taxation, every aspect that the client has in their wealth management or the wealth plan. And so the more tools that we can deliver advisors so they do a better job for the clients, the better everyone is. The client is better off, the advisor is better off, and we get more than happy because we are part of the process.
So Eduardo, you may be doing too good a job explaining this because we have a question that says, is there a limit of one's investable assets to be put into an annuity from a compliance standpoint, maybe due to liquidity concern?
Well, look, I'm not going to speak about compliance. I'll leave compliance on insurance issues to David and Mike. At this point, I'm more on the academic side, but think about that. You have a pot of money. Tomorrow you may need money because your daughter is getting married and you didn't know, and so you need that money. So all of us need to have some amount of assets that are liquid for whatever unforeseen or expected at the end of the day, expected demands we have in the future. So I'm not of the idea that you can just make all your assets illiquid by any means, but also sometimes you don't need 100% liquidity in all the assets if you get some benefit. When you think about institutions that have very long-term investment, sometimes they invest in private equity and they say, well, these are liquid assets. They may provide me a little bit of return. So you see even in institutional marketplace, people investing in less liquid assets. And so for certain clients, just getting tax benefits and getting protection from other things that are not bonds at the cost of losing a little bit of liquidity makes sense. But that's, the advisors have to do that client by client because that's why they create.
Well, that's the job, right? That's why that's their job.
They know more than us about the end client and the need. Every client is different, and the advisors do a great job as a fiduciary helping those clients.
For sure. And I just think it's very interesting because if you remember a few years ago, like 10 years ago, people didn't really talk about, advisors didn't talk about tax advantages of products or tax harvesting. This is another thing to talk about that really you need to talk about with your clients. You got to talk about the risk profiles and also liquidity issues. This is something we should do. And now you've got a product to address that.
Taxes are extremely important. We in asset management just work very, very hard to get extra basis points. When you think about taxes, you're speaking about in 25 30 plus in California, we pay quite a lot. I'm in California. So you're speaking 50% on income in certain cases. So it's a big number if you can do anything that alleviate that pain. It's certainly it's a real benefit. So but the advisors have a tool to help. Like ETF is a tool. We used to have separate mutual funds be the most popular vehicle. Now ETF is the most popular vehicle when you think about investing in liquid assets in public equity or public fixed income. And why? Because it provides tax benefits. Well, this also provides a tax benefit. Fixed index annuity provides a tax benefit. So it can be a very good tool for some clients.
Right. Mike or Dave, did you have any questions for Eduardo?
I'm going to pass for the sake of time. And David, do you have any?
Relative, one of the at Advantis, you created an index. If you just want to maybe give the quick high level of what the index is like, I think it's one of the unique indices available in the market today.
Yes. So when we're speaking about FIAs, so fixed index annuities, I was mentioning that the performance, the upward that you get, is it's linked to an index. So when you buy a bond, the upwards is linked to the yield of the bond. When you buy an FIA, it's linked to an index. And you can say, well, it's linked to the S&P 500, or it's linked to the Russell 2000, or it's linked to whatever commercial index that you see out there. Well, you can do a little bit better. You have a better index. Our call to fame at Advantis is trying to create better investment solutions by using financial science. So what we did with a security benefit, Barclays and DPL is create an index that is using some of the well-known premiums in academia in order to create higher expected returns, well diversified, but higher expected returns. And at the same time, we did thinking about the costs, because remember, if you create a very expensive index, the hedging that is underlying in all these instruments, the fixed index annuity or the RILAs, is very expensive. So you need to create an index that is liquid enough, that is easy to hedge, but at the same time, you want to create an index that has higher expected returns. And that's the kind of index that we create using just well-documented premiums like profitability and whatnot. And so it was quite a nice work. And the partnership with virtual partnership, we don't have a partnership, but it's just the working together that we environment that we have with Security Benefit, DPL, and Barclays was quite interesting, because all of us put the best we could in order to create something that we think that is very good for the client.
Right. Thank you. Yeah, we do have a bit of a time issue now. We gotta move through. So David, I know you want to talk a little bit about solutions.
Oh, I'll go quickly because we touched on a lot of them.
Yes,
so we're looking at, again, seeking portfolio income. If you haven't looked at annuities for income, you really should. They're really efficient. I mean, and someone asked a question about, what kind of death benefits, can you get? Well, I mean, death benefits protected, but living benefits on the income side, you can get, better than 10% guaranteed lifetime income payouts in commission-free annuities right now. You should be looking at that. As Eduardo was speaking about, diversify fixed income allocation, your source of return, coming rather from, interest rate yields coming from the performance of an index, which may be equity-based. And also de-risking, whether, like I talked about earlier, whether de-risking equity portfolios or fixed income portfolios, or you want to, if you've got client annuities that are, that were sold by, someone else, or that have high fees or whatever it is, you want to repurpose them and reduce the fees, provide better benefits. Let's look at, clients who have existing annuities, and let's align them to their, financial, their current financial plan.
And I'll just jump in here,
Sure.
Tony, real quick. The next two slides on planning software and technology and billing. Again, this may be news to some of our guests, but all the advisory annuities, I should say all of them, but many of them, we have direct feeds to, whether it's Money Guide Pro, Advisory, Money, Orion, we put up here. And on the next slide, you can see that with the technology and the billing systems, we can take the annuity values and positions and send direct feeds to a number of portfolio management vendors. Black Diamond's not here, but that's another one, that big one that we all work with. And billing is always a question that comes up. How do I bill? And you can easily bill through these portfolio management systems or directly with the carriers. Carriers all have that we work with have an advisory platform for trading and billing. And we
So one thing, Mike, we do have one question that I wanted to ask, and you're kind of touching. It was my favorite question that we got to the whole thing, but can fee-based annuities help grow my billable AUM? So I thought that was a direct question.
Well, we've actually got data on that. So, we've conducted, survey of, like I said, we support thousands of advisors and firms across the industry. Over 40% of them report to us that we've helped grow their revenue by at least 10%. 40% say we've grown their revenue by at least 10% simply by introducing annuities, and 10% report that we've helped grow revenue by at least 30%. So it can have a meaningful impact on your practice. Additionally, 67% of the firms we work with say that we have increased the value of their practice, which is really an incredible number. And 26% report that they're getting additional referrals because of their ability to provide a differentiated offering like commission-free annuities.
Awesome. Sorry to interrupt, Mike, but I thought it was the right time for the question.
No, perfect. And just don't forget that we certainly recommend. People always ask, how much should I bill? That's subjective, but make sure you do. And that usually works out, and that's a conversation that we can have individually as far as what most advisors how they're billing and how much they're billing.
Yeah, it's fantastic to have this conversation wrapped around a commission-free product, right? The client beneficial type product. So that's great.
Yeah, because Tony, some of our advisors they like to bill directly from the products, and others they'll ask, well, what about if I don't bill in the products, but I bill from another source, from the brokerage account or something like that? You can do that. That's no problem. I would say that, to my knowledge, the fixed annuities that are out there, the MYGAs, you cannot bill in the fixed. But other than that, whether it's the FIA or the RILA, everything that David's talking about, the variable annuities, you can bill directly in those products.
Fantastic. Well, we are running out of time, gentlemen. If there's anything else you want to talk about, maybe the key takeaways, Mike, before we get.
Yeah, real quick to wrap up the CE. Thanks, Tony. Is I think we've pretty much covered that. The annuities have really changed drastically over even the last 5 years, and some of these fee-based products offer better value for your clients, and with the commissions removed. David has certainly touched on that. Annuities can be a powerful solution for both accumulation and income. Supportive by the academic research that we have that can be provided through DPL, guaranteed principal protection and income, and we can help. Certainly, these annuities can help reduce the sequence of returns and longevity risks. And where we fit is certainly especially when you think about like an FIA. When do you buy it? Certainly what we're seeing is 5-10 years from retirement. The sweet spot seems to be late 50s, early 60s. We're seeing a lot of movement there. Clients and advisors concerned about market volatility, and want something that is index linked, but with the without the ability that they're without a risk of loss as far as the FIA. So I'll just wrap it up and say that when you think about the financial plan that you're all putting together for your clients, whether it's accumulation, secure, efficient income, the annuities do have a role to play, and it's really a way that we can help you, as we've discussed, that we can help you capture some of that lost AUM that may be out there with your clients that you don't even realize that you can bring in that, and we're really here to help you do that. So I'll pause there.
Thank you very much. Fantastic. Appreciate everyone's participation. We are, believe it or not, an hour. That was a quick hour, but thank you so much for being here, everyone. And thank you to the folks in the audience. We really appreciate it. And we'll be following up. Thanks, guys.
Thanks.